informed and successful year ahead. Without further ado, I'd request Mr. Dheeraj Relly to kick off the presentation. Over to you, sir.
Thank you, Manat. Good afternoon, one and all. Thank you so much for joining us today in this afternoon. We are just at the fag end of the year, so looking for 2025. I think last few years have been very good years for the markets. We've all celebrated post-COVID times with the wonderful returns in the market. It was almost easy for everyone to showcase that they have outperformed and they have done well, be it the fund managers, be it individual investors. So how are we navigating the 2025? Going to navigate the 2025 is something we'll focus on. I'll talk a little bit about the global environment, and then my colleagues will take it forward from there onwards. What can be the better time to talk about the global environment, where we had an important event yesterday night, where the Fed has cut the interest rates by 25 basis points, and also that too accompanied by the hawkish commentary, and everyone in the street was expecting that we will have 100 basis point cut, and suddenly a significant shift in their commentary narrative that it will be only 50 basis point. I think that's something we will talk about it in next few minutes in more detail. And let's go ahead with the presentation. Yeah, so this is the overview. I think you all have presentations, so I'll straight away go to the slide. We feel that the rate cuts have started, and this particular slide showcases that how many rate cuts we are expecting in this calendar year. 124 is the number. We baked in the last rate cut also in this already. So we believe that the inflation has eased out, and also the growth has slowed down. I want to tell you one thing: the monetary policy's impact come with a lag. It is not an immediate, it's not a magic wand that changed the trajectory of liquidity in the marketplace so easily. It comes with the lag. I have seen when there are rate increases, when there are rate cuts, the impact follows in next few quarters. So that's where it is. After 2022, we've seen a cycle where we've seen the rates are going up only, and only off late we've seen some rate cuts. So the impact of the increase in the rates was also visible in last couple of quarters. Only it took some time for that to had its own impact in the market. And similarly, when we'll see the rate cut cycle, it will also have its own sweet time. So we will see the impact coming in with at least 2 to 3 quarter lag in the market. Essentially, what I'm trying to articulate here is that it's not that with the rate cuts coming in, the cost of borrowings will come down for the industry at large next day itself. It takes time to have its own impact. More positive impact or negative impact come with the physical, basically more fiscal policies than the monetary policies. So growth is one area where we have seen some struggle, not only in US but also in Indian economy also. So moving on to the next slide. Yeah. So we've tried to showcase that how central banks have been working on various things and what were the fight. You can see that in the last there is a inflation fight, and we have seen this is where we have started to see the easing a bit. So this was the period when the interest rate was going up, and that's where we have started to see the interest rates come. And of course, the chart covers the scenarios, different scenarios from 2008. I'm not focusing too much on the slides. I believe that you have the slides with you and you can go through these slides. But again, there are major central banks who have their policy rates over whatever their upper bands are there. That's something we've shown in the this slide for you. Also, the next slide we talk about the Fed projections. Of course, this is a old slide. This got changed yesterday with the yesterday event, and instead of 4 dots, you will see now 2 dots, and that means 50 basis point rate cuts. And my take is that Indian Central Bank in any case have been taking it easy. So we will not cut rates in India in a hurry. That's our estimate. And I think though our growth has slowed down in the last quarter, but this is something, even Finance Minister articulated very clearly that this was a blip and not a norm. So we will expect a growth to pick up from the third quarter onwards. My take is that we will have this year plus minus of 6.5%. For next year, we will have plus minus 7%, more or less, 6.7% kind of growth. But overall, global growth has slowed down, and that's what warranted a synchronized action from the most of the central bankers. And though Fed has made this commentary that there'll be a 50 basis point cut, but I think that they'll be more data driven, and like things changed dramatically last night, things may change maybe 2 quarters from here onwards, because we have many events, many significant events lined up post the outcome of general elections, what we had in the last year. So moving on, US Fed rate and dollar index, you can see the correlation here. Generally, there is a positive correlation. Dollar attractiveness falls when there are fall in the interest rates. So that's where we are. We believe that there are contradictory narratives, though narrative is that by the newly selected president is that they want strong dollars, but historically whatever actions they have taken earlier, it has led to a weakening of dollar only. So we'll have to wait and watch whether how the narratives will translate into the real actions in the marketplace. So so these slides will give you a more perspective on the inflation side. So inflation peaked somewhere in the 2022. It was, for the world, inflation was as high as 10%, largely fueled by the helicopter money that we've seen in the COVID times. All central banks globally eased out their policies and pumped in the money in the ecosystem, and government has also given enough and more helicopter money in the hands of the citizens, and that was translated into unprecedented demand-led inflation. So demand-led inflation can be to some extent tackled with the monetary policies, and that's where all central banks started to act on the same, and we've seen that the impact of the same now, and now inflation is, I think, more or less within the range. For India, it's still slightly on a higher band, but globally, if we see that, we've seen that the peaking of inflation is definitely behind us. We are at a moderately to closer to the acceptable levels of inflation. Just to remind you that a decade before COVID, the entire Europe as well as US struggled to reach 2% inflation. So that was one different struggle for them. They always had a narrative to reach 2% inflation, and despite all possible action, could never reach that, and it's just the COVID did all the trick for the markets, So that's where we are, and though we are seeing some stubbornness in the inflation still, we believe that the real war against inflation is behind us. Okay, that's where we are seeing some rate cuts. Speed of the rate cut, number of the rate cuts can be debated, but we are definitely in the trajectory where we'll have rate cuts, and yields will come over a period of time also down, not immediately. As I just said, that the impact of the monetary action comes with a lag and not an immediate action. So the next slide will give you some perspective on the GDP growth. We've seen that it has eased out. For just focus a little bit on the world side. So we are closer to 3%, shade less than 3%, and that's where there are concerns. Though large economies like US and India have been more resilient, particularly US, so the growth has been more and more resilient. That actually took, that's why Fed has to change their direction a bit, not direction but the impact number of cuts. So that's where we are. So we believe that the growth will slow down at a world level. However, India Indonesia, some of the Asian economies will remain outlier. And also it is pertinent to mention here that the China is struggling with the growth definitely, and that's visible in the last few quarter sprint we have seen at China's level. How are we doing? All okay? Speed is fine with you guys? Yeah. Just to talk about now the PMI, I think the most of the heavy lifting in the PMI side is done by the service sector. Manufacturing side, we are still seeing more or less range-bound PMI only, and that's where the real concern is, and that's the concern we have in India as well and globally. Yeah, so how global assets have performed? No brainer, absolutely. Equities were outliers last year for a significant returns, over 20% kind of returns in the markets, and whereas bonds and commodities have underperformed, 2 to 4% kind of returns only. Again, the chart for MSCI World Index shows the almost like a one direction movement only, barring very small correction in 2022. We haven't seen any correction in the last 2 years. So we are fully valued at these levels, at a world market level also and India also. In fact, the big concern here is that we are approaching year 2025 with the markets that are fully valued. Having said that, this doesn't mean that there are no opportunities and equity as an asset class will not do well. My take is that the equity and asset class will still continue to outperform other asset classes in India as well as globally. But we have to moderate our return expectations from the equities because we are approaching it with the full valuations, and also some uncertainties due to the some policy action from the largest economy in the world. You all are aware of the narrative coming in from the new president on the tariffs and his stance on the geopolitical issues. I think this would continue to weigh on the markets, as well as monetary policies can only do something about the demand side of the inflation. If it is supply chain side related inflation, which means if there are tariffs which make most of the commodities expensive, and if there are persistent geopolitical issues that make supply side more difficult, and protectionism policies adopted by and reaction to those policies by different countries, that can lead to more headwinds for the inflation. So that's where there is a significant uncertainty, and that may lead to a volatility also. At least for a first two quarter, we may see some easing out in the volatility from quarter 3 onwards. This is again the Bloomberg world market capitalization. Again, story is same, unilaterally growing in one single direction, and it's now $130 trillion, close to $130 trillion. And chunk of it comes from the US, almost close to 50% of that, and within US also comes from a magnificent 7. The 7 companies market cap is almost $19 trillion. So something that we have covered in this slide also. We've also shown you in the next slide how the this is about how this S&P versus the MSCI world ex-US. So that's something very, very important, that US markets have been an outlier. That's why you will see this comparison. And moving to the US equity receiving disproportionate higher amount and flows. I think this has been the story for last few years, 2021 onwards, and we see this to continue because the US economy have been resilient, and with some change in the policies which leads to more protectionism, we believe that US will continue to attract more flows. We believe that Indian markets will become more attractive when we start to show better earnings from the FY26 earnings. That's when we'll see the more and more participation coming in from the FPIs also. This year we've seen a significant outflows from the foreign portfolio investors, but Indian market is growing well. Earnings growth trajectory is also looking good, something that my colleagues will cover about the Indian markets. And that's where my personal take is that it's difficult to bet against India if you are a global investor. So that's where we believe that we will have positive flows. In any case, in the FDIs, we have seen a significant traction, and we believe that that traction will continue. In fact, the large part of the incremental growth, world growth, is going to come from the Asia, and predominantly India will be the outlier in terms of among the large economies in terms of GDP growth. So it's not that the markets have performed on the euphoria. So markets have performed well because there have been good earning growth also. This is visible in the total returns as well as the earning growth chart. So concentration has increased, something that I've just spoken, that how few companies, like 7 companies, Magnificent 7 has got the $19 trillion market capitalization, but they have their own moat. We believe that they will continue to do well. We do not have any coverage on these companies. We do not have any recommendation on these companies. Just giving you a personal view on that they have their own moat, and they will leverage technology, particularly generative AI and AI more, and that's where we believe that they have an edge over other companies. So that's where they will continue to remain as dominant companies in the world. So balance sheet, moving on to the G4 balance sheet, quantitative tightening yet to partially done. We believe that if balance sheet has grown significantly from 2006 onwards, if you see, this been going in one direction only largely. So if there are quantitative tightening done, like balance sheet has grown significantly, if they try to reduce the balance sheet, that may have a negative impact on the global economy at large. One big worry for the market is that the debt has risen significantly. We are at currently global debt is about 323 trillion. This is significantly higher than and many multiples of the world GDP. And that's where the concerns are, and particularly, US has got large, it's a large economy and large debt also, so that is something negative. And you can see in this slide, India is at 182%, US is at 253% debt to GDP ratio. I think these are not sustainable, and that too when you particularly have a higher interest rates still going on. Yield at US is about 4.5%, increased to 4.5% yesterday, and in India it is about 6.75%. These are unsustainable cost of interest borne by the various governments, and this story is true for almost all other countries also, barring Japan, where you still have a reasonable cost of funds. So this is on the slide before that, okay. So geopolitical issues, still the struggle is going on. We have no visibility when we will see end of war, or whether there will be more escalations in this war. We keep hearing that there are some solutions are being worked out, but again, no expertise in this area, so can't comment much on it. But it will, at some point in time, it will have its own negative impact on the global economy as well. So biggest learning for me for calendar year 2024 is that we need not to be unnecessarily perturbed and overthink about the macro events like elections outcome, or even the outcome of Fed or other central banks. We need to focus more on what is in our circle of influence, that is how you can mitigate the risk and how you can optimize your investment decisions. When we started the year 2024, the overhang of so many countries, in fact, unprecedented elections we've seen in the 2024, so many countries and large countries like US and India gone through the elections, and we've seen enough and more drama around those election outcomes also. So look at it now. Still everything, all elections are behind us. Some rate cuts, speed, lesser speed, all those macro events, again, continuation of the geopolitical issues like war by various countries, all that behind us, and we still have a decent equity market performance, 20% plus kind of a return at a global level. I think despite all these, even this is something, phenomenal, and my learning is that one should focus more on to the what is in your circle of influence. So with that, I'll take a pause and I'll hand it over to my colleague to take it forward, the Indian environment. Thank you.
Thank you, sir. I hope I'm audible. Yeah. So I think sir has covered it very well. I think what I'll try and do is put all of those conclusions into the Indian context. So while we'll cover all these topics, I'll do it in a little bit of try and kind of marry that into how it plays out in the Indian context. So let's start with the bad news so that I can end on a positive, because finally, India is a great place to be, right? I think where the bad news can come through this year is if you look at what's happening on the GDP, and I'm talking more about FY26. So the way the trajectory is likely to play out is that if you look at FY25, the first half has had a massive disappointment on government capex. We are not believers of the fact that the big numbers on the private capex are going to show up in the second half of the year. While you will start to see some green shoots in that, I think what will end up happening is that in the second half you will see a uptick in the government capex, but maybe they will not meet the target. What does that mean? That means that on the fiscal things will look great because we would have not spent the money. But at the same point in time, there will not be that growth impulse that growth pulse going through the economy that is expected. So if you see our GDP numbers, officially RBI estimate is 6.6, we are at 6.4, and honestly that has a slight negative bias to it. So the possibility that we'll miss our GDP number is there. The second is that at this moment in time, the consistent view is that on inflation with the monsoon, Kharif crop has been okay, Rabi sowing is fine, we'll start to see inflation numbers come off. We believe that will come through. What that means is that the RBI gets a little bit of, with a new governor, they'll get a little bit of headroom to be able to play around with rates. But at the same point in time, given, the balance on both sides, I think that the overwhelming majority of analysts today on the street believe that we will get a rate cut in Feb. I would say that the probability there is 50-50. It's not that close because, actually, very interestingly, MD was also saying that if you look at the history of inflation, you will find that even when, you go back to the bad inflation periods of 70s or even in the 90s, you will find that actually, usually you get a couple of disappointments before you actually win the war. It's usually a 7, 8, 10-year cycle on inflation. Does that mean we'll not win? The answer is the war against inflation will be won. It may just be at a slower pace than what people think. Okay. On the consumption side, I think it is now well established that because of inflationary issues on the urban side, there has been disappointment. While on the rural side, because of the monsoon and the fact that there is a lot of spend from governments incrementally due to election pressures to spend money at the bottom of the pyramid, that we will start to see some consumption coming off. What that effectively means is that the trend for the next 1 year will be a large gap in the middle. So what you get is absolutely at the bottom of the pyramid, you get money which is coming in from the government and the rural economy coming through. And at the top end, the K-shaped recovery is well established. People who are invested in capital markets, who've made profits, whose businesses are doing well. So what will happen is that at the absolute top end, you get some positivity, and at the absolute bottom, you get some positivity. There is a large gap in the middle where basically people keep struggling against inflation and the slowing down of growth. Now, so that was the bad news. Okay. पहले बता दो तो वो better है. So now, how do you play this, right? So interestingly, yesterday I was at a dinner where there was a couple of entrepreneurs and they were saying, यार उनमें तो बहुत मंदी कर रहा है यार. And I was telling them that that's not what I'm trying to do here. Okay, what I'm trying to do is that if you have a lay of the land, then you can invest accordingly. And why I'm saying this is because, I'm sorry, I'm going to take one of your slides. Okay, is that if you see even this year, okay, and this is his slide. I'm just taking it right now. But what I'm trying to tell you is that even if you look at the top and bottom stocks in a small cap index, you could have a stock which is a 4x, and you could have the bottom stock which is down half, let's say. What we are trying to do is that unless you can get the macro right, you will not know what to do in this bucket, because there are whatever, like 3,000 stocks you can invest in, right? So what are then the trends that you play in this, and how do you actually pick stocks, right? The first is, I'll cover the top end and then I'll hand over for the segments. So what you do is that you look at how the macro is marrying into this. The first is that in an attempt to boost the economy, the government's interest will be fully aligned to ensure that the government capex in FY26 will be not a disappointment. So you play all the industrials accordingly, and Varun will cover that. But so that is one big macro theme which will play out. The second is that the absolute top end of the pyramid and absolute bottom end of the pyramid, let's call it this consumer discretionary and absolute low end consumption. We believe that the numbers will start to improve from here on. What you have to look out for is where the top line growth is coming through. So that's the second part. And then what we believe is that on the geopolitics, which is what, even MD was talking about. Look, it's not, last year, everything, started to kind of deteriorate, whether it is the, whatever is happening in the Middle East and the war in Russia and Ukraine, is that you actually have to think about what's in it for me. So there is a fight going on over there. How does it impact us? If you look at the oil basket, which is where I think I'm going to say the positive news, which is the big learning for me in 24 was that given the fact that there is so much spare capacity, especially when oil prices tend to go over 80, that we believe that actually to a large extent oil prices will not cross 80 to 90. Now what happens is, from a macro perspective, for an FPI looking at India, the macro actually looks very good. The last time something like this happened in 2013, India was considered one of the fragile economies. Now this time it's not happening. So the good news is that, as MD was saying, that as soon as you start to see earnings kind of come back, we will start to see FPI interest come back to India. So the way to play this is that it is going to be a lot less easy to do macro investing in India, given that the entry point today is 2 standard deviations above the mean. So what's happening is a lot of strategy reports are talking about the fact that India is like 21 times on forward earnings as in FY26. And they are saying that it is only a 10% premium over or 5%, 6% premium over the last 5 years average. But that's not the right way of looking at it. You have to look at the long-term average, which is 10, 15 years. In that case, it is 2 standard deviations above. So when you're entering a market at a macro level at 2 standard deviations above, you need to be very careful. And which is why I think, well, that's the role of advisors like ourselves. So this is going to be a year where, given the government capex, given the fact that there will be a little bit of disappointment, that you will start to see very flattish kind of equity returns for the year. But at the same point in time, just like the chart I just showed you, there is likely to be a very large amount of money being made in stocks where you will get the earnings to come through. And that is something I think I'm going to leave to Devarsh and Varun to cover.
Thank you, Unmesh. So, yeah. So to set the context for the segment performance and to bring out the point which 2 senior colleagues have already spoken about, let me start with a story, a small story. There are 2 young fish in the water, big ocean, and they are enjoying their lives. They are swimming along. On the opposite side, one old fish comes and nods at the younger fish and say, "Good morning, boys. How is the water?" and then swimming along. Two young fish looks at each other, they swim along. After a while, one young fish asks the other, "What the hell is water? What the hell is water?" So the whole story, the point of this story is that sometimes the obvious reality around us, the environment, is very easily ignored. It is very difficult to talk about, it is difficult to understand. And the macroeconomic or the geopolitical environment or the returns which we got in last 4 years, the environment is changing. See, in 2020, we had about 4 crore investors, Demat accounts. In 2024, we have about 18 crore Demat accounts. 14 crore new young investors have entered the market in last 4 years. According to NSE, 40% of our investors are below age of 30 and they have started in last 4 years. These young investors have invested in an environment where money was very easy to be made. You take highest risk, you take bet on small companies and you make a lot of amount of money. And that's what is being shown in these charts, that the small cap made more money than mid cap and mid cap made more money than the large caps. And that's how even IPOs have given fantastic return as early as yesterday. Yesterday we got 3 IPOs listed and all of them gave bumper returns. So more risk you take, more money you have made. Second key takeaway which I would like you to understand, and through you all the young investors, is that eventually price and earnings converge. Stock prices are slave to earnings. And if you see here, this is the benchmark where price and earnings have moved more or less in line, where about 13% earning growth, 16% earning growth has met with a 13% price rise. While in mid cap and small cap you see earnings growth of around 12% while the price has gone up about 28%. Similarly, 13% earning growth and 30% price rise. So price and earnings have diverged in mid cap and small cap last year. So the message is that next year, given the environment is changing, given the water is changing, we are all these 14 crore young fish, be careful next year. We should have bias towards the larger stocks, larger companies where they have seen multiple cycles, they have established their business, they have the management who has seen many seasons, many cycles. They will be able to navigate the uncertain environment of 25 with ease. At the same time, there will be some individual companies in mid cap and small cap which will be able to ace the environment, where there will be huge earnings growth, and that's where they will also see huge returns. So our focus or the advice for the young investors in 2025 is that if you are putting new money, the bias should be towards the large cap. 60% of the money should be from your incremental investment should be towards large cap, and another 40% you should divide between mid cap and small cap. That is the advice. Now where to invest, that we will cover after my colleagues have shared their portion. Thank you.
So this is what we were talking about. I was waiting for him to finish. So we'll come to the sectors, and then I'll invite Varun to discuss the rest. So these are the macro trends which both Devarsh and I have covered. So if you look at this from the perspective of risk, our general bias for large cap and general bias for economy facing government capex type rising risk environment. The sectors that we really like are large banks, top tier IT, consumer durables, which is again top end consumption, capital goods, real estate, cement, which are all plays on the capex cycle, and building materials. The areas which we don't like, auto, consumer staples, though I think on that one we are selective. Oil and gas is really refining here. So mid-cap IT and small banks and NBFCs, because we expect the risk there to kind of rise. So on that note, I'll just invite Varun to continue.
Yeah, hi. Am I audible? Okay, so I'll quickly take you through our views on various sectors, what Unmesh alluded to and why, we are looking at sectors in that way. I think overall, I agree with what Devarsh is saying. 2025 will be a much more difficult year from equity returns perspective. Last couple of years, 23 and 24. In fact, if you look at 2023, almost everything went up. 2024 already we have started to see a lot of divergence last 6 months. There has been a good amount of volatility, and lot of sectors and stocks now on a 12-month basis have given fairly decent negative returns. At the same time, we have stocks which have given 100-200% up as well. And but still the underlying tone of the market is still very, very bullish, and it's quite visible from things like Devarsh was saying. All the 3 IPOs yesterday were up, and most of the listed market, which is secondary market, is down, and that has been the trend pretty much in the last few months. And this divergence typically does not stay that long. Suddenly you have select small caps and mid caps, because they're operating in the same macro backdrop, that their earnings growth will continue to outperform what is happening at an aggregate level. And frankly, if you look at earning growth of mid and small cap, have not been that great even in this financial year so far. So the PE expansion has been much more in those spaces, which makes us slightly more cautious. So now looking at some of the key sectors, we'll start with BFSI, which is banking and financial services, the largest sector. In our model portfolio now we are neutral. We used to be underweight. We are adding banks. We see probably the best risk reward from a 18 to 24 months perspective in this sector, especially the large banks. So again, it's a sector where things are very nuanced, and you have to play. I think banks which have large, well-diversified books, both on the liability side as well as on the asset side, because there is still some pain in terms of the asset quality on the unsecured lending and microfinance, which we believe will continue for next 3 to 6 months. But at the same time, at an overall banking sector level, we are not going to see a significant spike in NPAs, because the corporate cycle, the corporate books are in very good shape. And even the secured, retail part is fine, and our overall view on economy from a 2-3 year perspective is still positive. So we don't see a big impending, NPA cycle in the banking sector. So large private sector as well as public sector bank look quite attractive to us. They have derated massively. Just to give you one data point, 2019 banking sector was at a PE of 35 times when market was at 19 times in Nifty. And so basically X banks, Nifty stocks were at 14-15 times, banking sector was at 35 times. That was the time when, Kotak and, all the banks and large NBFCs were trading at very high valuations. And rest of the market, which is the economy facing sectors, be it telecom, autos and everything, were dirt cheap. And only 2 sectors were doing well, which was banking and consumer. And they were both at crazy valuations in relative to other sectors. Fast forwarded to today, which is 5 years out, the story has completely flipped. Banking sector is now trading at 15p. So it has derated by 50% from 35p to 15p. If you look at Nifty X banks has re-rated from 15 times to 30 times. And if I actually X out some of the oil and gas companies which are quite large in terms of earnings, that number would be closer to 40 times. I think when we take a look at today and take a 3 to 5 year view, we see the probability of making returns on some of the Nifty X bank stocks will be lower. Not to say that you will not make returns out there, but you have to kind of just lower your return threshold in that sense. Whereas banks, we believe, offer very good risk reward from a 3 to 5 year, and therefore they should be a core part of the portfolio. But again, we are more positive on large banks, and we are still negative or cautious on mid-sized banks unless they have a very specific niche or a business model which is difficult to replicate for the larger banks. And we are still underweight on NBFCs. Again, unless there is something very specific with that NBFC in terms of moat around a single sort of a vertical, or in terms of understanding the asset side better than some of the banks. So BFSI and the arrow indicates our bias in terms of, as I said, we were underweight, we are adding, and we have gone to neutral. So basically positive, like the green arrow means that we are, at the margin we are getting more positive. And if there is a further correction in next 3-6 months on concerns of, slowdown in economy, we would be looking to buy banks more aggressively. We are not, like, just to give you our overall macro backdrop, we are not overly worried on India's growth rate. If you look at, GDP growth, while this year will be around 6.4, as we have said, next year our forecast is going to be around 6.6, 6.7. So there will be an acceleration after this, slowdown which we have seen in first half. Similarly, on earnings growth for the market, first half has been particularly weak. But we were, it was something that we were very cognizant of. At the start of the year itself, we had said that earning growth for our coverage universe will be around 7%, when everybody was building in 12 to 13%. It has actually come below our estimates as well, and our now full year forecast is around 3.5 to 4%. But to us, the negative surprise wasn't that much. But if you look at the constituents where it has come from, we are not overly worried. We believe there is, we are in midst of a mild cyclical sort of a slowdown, macro slowdown in India. But from a 12 to 18 month perspective, like, we are still in a structurally uptrending macro environment and GDP growth sort of environment for India. And within that, it's a short 6-9 month sort of a slowdown. So that's the overall macro backdrop. In terms of the next big sector, IT, we had cut our underweight on this and turned neutral right at the start of the year. But this year it has been one of the stronger performers. But we are not getting overly excited, and we are not adding any positions in case of IT. In fact, we have sold some mid-cap IT where valuations have become really expensive. We only have the large-cap IT names. And frankly, if there is, risk reward is starting to become unattractive, given the growth uplift, even with, things getting better in US next year. We don't think this sector will go into high teens kind of earning growth. We'll still get to high single digit to low double digit kind of earning growth only. And in that context, valuations are starting to become, slightly more demanding, and therefore IT, if it rallies more in the first half of this calendar year, we would be turning, underweight in that space. Consumer staples, we have been negative on consumption for almost 4 to 5 years, partly because the valuations were really crazy at the, as I said, in the context of other sectors. And secondly, in terms of earning growth, the levers were missing, because from 2015 to 20, the main earning lever for consumer companies was margin expansion, which obviously in the midst of inflationary pressures would not have continued, which has played out. And, the margins have sort of flattened out, and top line growth anyway has been quite anemic. So in that context, the sector didn't look very attractive. If you look at last 3-6 months, there has been a lot of, especially last 3 months, there has been a lot of concerns, questions on consumption in India, whether, we are seeing a very sharp slowdown, or, has something gone massively wrong with India. So in terms of our view out there, we believe consumption is still, not has not fallen off the cliff in India. If you look at the pockets, as Unmesh was saying, the top end is absolutely fine. We are continuing to see good numbers. In fact, the big ticket items, if you look at all big ticket purchases, they have been doing reasonably well, be it real estate, be it travel, be it, even automobiles, the top end cars, they are doing fine. Even, the festive season from the categories, again, the big ticket categories, be it consumer durables, be it, real estate sales and all have been quite okay. So there has been a pain in the middle, which is what Unmesh alluded to, that be it urban poor, it's not to do with urban or rural, it's more to do with, the income levels, because there has been an inflationary pressure across the board, and therefore wherever the income levels have not kept pace in terms of with the inflation levels, there has been a pinch out there. So urban poor has suffered a lot, and similarly rural poor, those are the two pockets where there has been a slowdown in consumption. And as inflationary pressures ease out, in the next 3 to 6 months, to an extent, we'll see some of that coming back. And at the bottom end, I think on rural, generally the rural farming side, the outlook is looking a bit more positive for the coming year in terms of the crop sowing and, some of the on the ground feedback which we have. Things are improving at the margin. They are not, I would say there is no big V-shaped recovery that, there's a very sharp uptick in rural consumption, but it's not worsening and it's gradually sort of coming off. And as inflation cools off, it will probably improve further. So I think the macro consumption story is still intact in India from a medium to long term view. The discretionary spending will continue to gain, greater share of wallet. And we are not overly worried with this consumption slowdown. I think the stocks, which, there was a bit of expectation mismatch after the election. There was a hope that, suddenly government will become very populist and will come out with a lot of money at the bottom of the pyramid, and therefore there will be a very sharp recovery out there, which didn't play out, and therefore, the stocks saw a negative reaction after the Q2 results. But it was more due to the positioning, which was very bullish going into the results. If you look at the trajectory of numbers for most of the companies, the trajectory hasn't changed significantly. So it's not that the growth suddenly has fallen for all categories in Q2 in consumption. It's more to do with expectations, which was of an improvement which didn't come through. But we believe it will come through in calendar year 2025, but still, valuations are on the higher side, and it's very company specific. So therefore, at an aggregate sector level, consumer discretionary and consumer staples, we are negative, but it's very, very bottom up. This is a sector where, there are 10 different categories. There is jewelry, there is apparel, there is QSR. Everybody has, all of them have their own sort of micro trends. So therefore, it's very bottom up, but overall, we are not overly worried on consumption. We are happy to add names wherever we are seeing opportunities. In fact, we have been adding some of the consumers' discretionary names in this downturn, which happened in the last 2 to 3 months in terms of the stock prices. Industrials infrastructure, we continue to remain positive. We believe we are in midst of a multi-year sort of a uptick out there. Government, in the upcoming budget, we don't think will significantly step up the capex further. They already, last year was 11%. This year again there will be an increase, but it may only be a high single digit kind of a number. But on that base of almost 11 lakh crore, which the government capex has been, even a high single digit growth would be a good number. So we believe government will continue with its sort of pro capex, sort of investment theme, rather than doling out freebies and giving money directly in hands of consumer. We believe that's a better medium to long term strategy, and we don't see them deviating from that. And fiscal prudence would be maintained in the upcoming budget. So industrials, while valuations have become quite punchy, and we had gone underweight in this space around 6 months back before elections. But now in this recent correction, wherever we, because some of the industrial stocks also had corrected sharply, industrials and real estate. So we have gone and added them and again become overweight in this space from a next 12 to 18 month perspective, as we see a positive cycle on both of these sectors, real estate and industrials, from a 2 to 3 year perspective. Cement, we have been underweight so far, but now turning more constructive, while valuations again in this sector in large caps, this is one of the sectors where actually large cap valuations are a lot more stressed than mid cap because of the way industry structure is evolving, partly rightly so. But I think some of the large caps leave very limited room now in terms of cement sector, but in terms of some of the mid cap stocks are available at fairly attractive valuations, and as demand and pricing uptick comes in 2025 compared to 2024, we'll see better share price performance out there. In terms of automobiles sector, we are negative. We have been cutting our weights given a very strong run in 2023 and first half of 2024. Valuations had become on the higher, had gone to the higher end for this space, and again given it's a well-known, well-discovered space, so growth typically can't kind of go beyond a certain number. It's not a non-linear growth which you can't anticipate. So in the context of the growth which is going to come through, valuations are on the higher side and rightfully correcting now, at least in the last 3 to 6 months. So I think if they correct a bit more, then some of the two-wheeler segment stocks would be probably the best ones to accumulate from a next year perspective. But some of the other automobile names and auto ang names, we are slightly less bullish for next year compared to last year. Chemicals, small sector, but last year was largely ignored given there was a price erosion and earnings didn't come through. We believe earnings are bottoming out in this sector, so slightly constructive from that perspective, but valuations are still very, very expensive in most of the cases. So therefore, the absolute upside could be limited even with improvement in some of the underlying numbers, but things are getting better at the margin. Oil and gas, large sector, we are underweight. Don't see any big reason to own most of the stocks given earning growth is quite tepid. And some of the select gas stocks after the correction have become attractive. So that's the only space within this sector where we are kind of evaluating and starting to find at least attractive risk reward. Pharma, lastly, Pharma has done quite well. We were overweight, but we are now cutting our weight a little bit. So we have gone to neutral from overweight, and I think both IT and Pharma are in a similar situation. Last 3-6 months, given the concerns on domestic economy, the domestic economy facing sectors have underperformed, and both IT and Pharma have done well. And in terms of their own growth rate, things were getting better at the margin, which got reflected in better share prices. But we believe valuations are starting to get full for the kind of growth that they offer from a medium-term perspective, and therefore, at some point in first half of this calendar year, CY25, one should switch back to domestic sectors more compared to some of these, the global sectors, which is Pharma and IT. So that's our overall, sort of view on various sectors. In terms of earning growth, as I said, first half was particularly bad, partly because of the base effect. But if we X out just oil and gas sector, because the OMCs had very high earnings growth in the base, and that has pulled down the overall market earnings growth as well, because they are very large sector in terms of earnings. So X oil and gas, even in first half, we have seen around 8 to 10% earning growth, and we believe from second half of this financial year itself, which is starting Q3 itself, as at an aggregate market level, will be back to 8 to 10% kind of earning growth. And for next year, the outlook is slightly better, around 12 to 13% on a X oil and gas basis again. So I think that's the number one should work with, and given where valuations are, I would be more tempted to expect some de-rating rather than re-rating from current levels, and therefore, if one has slightly more modest return expectations from market, I think there is no reason to be overly worried on equities, but one has to be very, very stock specific in 2025. It will be even tougher than 2024, because in 2024 still, there was still a lot of easy money in small caps and IPOs, and, but we believe even that may not last, because there is a lot of euphoria, which is not backed by underlying fundamentals in many cases. So 2025 will see unwinding of that, and therefore, within sectors also you will see a lot of divergences. So it's quite possible that some of the, say, large banks start to go up, but some of the mid-sized banks which are more exposed to those pockets of, where the problem is, they still continue to underperform. So you will have divergences. You actually need, more advisors in the next year, given how nuanced things are going to be, across sectors and within sectors. But nothing to be overly worried. In terms of our model portfolio, we continue to, these are some of the sectors and with the stocks where we are overweight and underweight. So I'll not go through the entire list. It's there in front of you. Happy to take questions on particular stocks if needed. But overall, our model portfolio continues to, actually we have not changed much. We have always been large cap biased, not to say that, clearly I think small caps were attractive. So I think part of the small cap run in the last 2 years was overdue, given they were more attractive at the start of that rally 2 years back. Even today, I would say mid caps is where the bigger issue on valuations are. Large caps and small caps are also expensive now, but they are not crazily expensive. Like again, at an aggregate level, small cap, it's difficult to talk in aggregates because it's a very, very bottom up sort of an index. But at an index level, mid cap is where, probably the greatest amount of overvaluation is sitting. And, select. So our model portfolio actually has more large caps. Around 65% is in large caps. That percentage we make sure does not go below 60%, even in the best of the times when we were very bullish on mid and small cap names 2 years back related to large caps. At that time it was around probably 60% the large cap weight, and today it is more closer to 67 odd percent. In the in the last rejig, we increased our large cap weight further, and now it is at 67-68%, which is probably the highest in the last 3 years. But we still continue to hold 30% in mid and small cap. So it's very stock specific. If we are convinced on names, and it's not that you can't find ideas in mid and small cap, but I think the point to keep in mind is, in last 2 years, probably 80 out of 100 mid and small cap stocks would have given you positive returns. Probably the ratio would be inverse in the next couple of years, that only 20 to 30% of mid and small cap names will give you kind of good returns. And therefore, if you are happy to kind of do your homework, happy to kind of go deeper into stocks and understand them better and own them for longer term, because that quick, easy money may not be there in the next financial year. Yeah.
Next. Thank you, Varun. So now I will take up the next topic of retail behavior in 2024 and expectations. Now here, by retail, we also mean the small HNI and the mid-size HNI, because now that category is growing very fast. As you know, 2 lakhs to 10 lakhs there is a category in IPOs. So that category, people applying between 2 lakhs to 10 lakhs, now that has grown manifold. So I will include that segment also in this talk. Next. Yeah. So as you are aware, Demat accounts are growing by the month. In this year so far, in the 11 months, we have added about 6.8 crore accounts. And totally, we are at 18.2 crore accounts. So if you will observe from FY20, we were at a base of 4 crores. From 4 crores, we have grown to 18 crores, which is a massive jump over 4 years. And this is one of the reasons why the dependence on local funds has increased, and the local funds have been able to offset the foreign outflows. Next. NSE active clients, 7 million accounts have been added in the 7 months. In the 7 months, about 0.8 crore accounts have been added, 80 lakh accounts. Now this again, if you will observe, we had 1 crore account in March 20. From there, growing to 4.9 crore is a very big jump. So financialization of savings, you call it the movement by the young generation towards the equity markets, the attraction to make money, add wealth over time. So this awakening from the retail and the small and mid-size HNI has happened over the last 4 years, and that continues. Next. So record amount of monies have been raised by Indian corporates. 1.6 lakh crore has been raised from IPOs, FPOs and OFS till October. This apart from QIP, about 1.3 lakh crore has been added in this period. So a total about 3 lakh crores has been raised from the markets in this period. Now, if you compare the QIP number of 1.3 lakh is versus 0.8 lakh crore in 2020, which was the earlier record, and the total of 3 lakh crore compares with 1.88 lakh crores in 2021. So the jump from the previous records is also quite sharp. Next. MF investors, the mutual fund investor accounts have grown. 22.1 crore is the folios that we have right now. The growth here has slowed a bit in this current year, but of course the year has not ended so far. Again here, if you will see, the growth from 2020 has been quite phenomenal. So the awareness towards making wealth out of SIP in mutual funds, if you call that, or investing in lump sum, has grown manifold, and this could continue going forward. Next.
In fact, I can just touch upon one point on IPOs. When I look at this, especially post Diwali till now, this is the first time I'm seeing that when FIs are moving out and we're still coming with more IPOs and all IPOs are getting successful, giving positive returns, is one of the kind of trends which we have never seen before. So it's a pure driven by the domestic inflows and the retail investors, which is keeping the stream up. Else, with FIs moving, there was times where nobody could even dare to, come up with IPOs. Filed IPOs were withdrawn. So this is the kind of new trends which we are seeing.
Right. Next. So mutual funds net equity inflows. Now over the last 7 months, we have been seeing 35,000 crores per month inflows, which is some sort of a record. If you see from November 19. There is a consistency of flows into the mutual fund. Now this includes your 24,000 crores worth of SIP, gross SIP plus lump sum investment. So there is a lot of interest of the domestic investors continuing in mutual fund side also, apart from the direct equity investment which has been growing from time to time. Next. Now there is a run towards the small cap stocks. The earlier speakers have talked about how small caps have performed well, and there is caution ahead that the segment may not do similarly going ahead. Now, if you will see, the retail shareholding in the Nifty small cap index has grown from 15.4% in March 23 to 16% in September 24. Whereas the FII holding has come down in small cap and mutual fund holdings have gone up. So again, mutual funds have to perforce invest in small caps when they receive money in the small cap schemes. So that is, but the FIIs are seeing some sort of, they are getting out of small cap and going into mid caps. Now within Nifty mid caps, the retail shareholding has remained more or less flat. 9.8% in March 23 has come down to 9.6% in September 24. FII and mutual fund both have seen an increase in their stakes. In the small cap, we have seen the highest monthly inflow in 13 months in November, in the month of November, whereas in mid cap, we have seen the highest ever inflow in the schemes in November 24. So even now at this stage, after seeing such a run up in small cap and mid cap segments, people are still sort of bullish on these two segments. They want to earn that alpha. They want to outbeat the Nifty without realizing the kind of risks that they will take going forward. At these levels, if they keep investing in small cap and mid cap, then maybe there will be some period of disappointment. But that nobody can do anything about it. I think people are sort of driven by the recent period returns. So as was shown in an earlier slide, the recent returns from small and mid cap have been quite phenomenal as compared to Nifty, and people expect similar returns going forward. Now we have given a table below. There are some penny and small value stocks where we are seeing very large holding by retail investors. So for example, now all of them may not be sort of bad investments, but typically the retail mentality is that आप मेरे को 10 रुपए से लेके 50 रुपए का स्टॉक दिलाओ, so where I can make multiple returns. So that is the thing we are trying to highlight. Now in Yes Bank we have 62 lakh investors. In IRFC we have 55 lakh investors. Vodafone, a company which is sort of struggling by the day, 52 lakh investors. Suzlon Energy, which was at one time almost going sick and now has recovered to some extent, 49 lakh investors. Then Reliance Power, again some company which has seen a steep fall in the price in the historical period, now trying to recover, 40 lakh investors. NHPC, 38 lakh investors. So again, this shows the kind of mentality of the retail investors, where they want to make very fast returns on low value shares, where they can buy 10,000, 1 lakh shares and see some large absolute returns. Now this backfires most of the time, but maybe if there is hope that even if 3 out of 10 works out well, they are home. Next.
I think we'll seek your help to burst some of these myths. Yeah, because retail investors are stuck, large number of retail investors are stuck in some of the underperforming stocks without demeaning any particular company or a stock. But if you just compare the number of investors of 6.2 million in Yes Bank versus SBI, I think the 3.7 million, it talks volume that how retail investors are yet not guided properly by the media and brokers like us. So we all have a job in hand to work on the same. Please do write about it and help us in educating the retail investors more.
Right. As I was discussing with some of you earlier, that retailers are sort of, despite the rise in Nifty, small cap and mid cap indices, a lot of investors are still sort of disappointed with the low portfolio returns that they make. This is one of the main reason is because the stock selection that they make is not optimal. They want to take very high risks in select number of stocks, and they are unwilling to sell at a loss. So these two reasons put together result in most retail portfolios underperforming the Nifty or the small cap or mid cap index. And this is something which we have to, as the MD has mentioned, we have to try and sort of correct this situation. Next, monthly flow of trend. Now here, what we have been seeing is that monthly inflows in the mutual fund schemes, mid cap, small cap, flexi cap schemes are still seeing rise in the monthly investments, whereas sectoral, thematic and multi cap schemes are showing some sort of a fall. So this again shows that mid cap and small cap schemes are continue to be in favor, as we discussed earlier. Next. SIP amount, all of you are aware, from the lows of April 20 of about 7,000-8,000 per month. Now we are at 25,320 crores in November, and this amount is slated to continue to grow in the similar proportion going forward, because this is one of the easiest way to make wealth for retail investors, which is not appreciated so far. Our MD has been very bullish on this theme of SIP, and which I think everyone should be adopting. You should have a part of your corpus or financial savings in SIP in mutual funds. The rest you can play around with debt or direct equity or whatever else you want. But that small portion of SIP in mutual funds will definitely grow in a very big way over time. Next. Now this is the proportion of cash market volumes and derivative market volumes. The cash market share of retail has fallen as compared to FY 21 and 22, but it's still very high at about 35%. The reason for that is the prop share has grown over time. So we are seeing a lot of brokers because the broking industry has transformed itself and regulations and compliances have become strict over time. A lot of brokers have stopped taking clients and they work only their proprietary desks. So their volumes in the market have grown significantly over the last few years. They do arbitrage, they do short-term trading, intraday trading. They have desks of people who do this kind of trading and make money for them. So their proportion has grown. The retail proportion has come down over the last 2-3 years. But FNO the market share has been stable at about 25%. Proprietary share has again gone up here, and corporate and DII share has come down over time. Next. Life insurance policies. Now again here we are comparing FY25 year to date, but broadly over the last 5-7 years the number of policies issued has not increased despite a lot of awareness campaigns run by insurance companies. But the value of the sum assured has seen an increase. So we are seeing people subscribing to larger policies, but the number of people subscribing to insurance policies has not grown to that an extent as we have seen in mutual funds or in NSE active clients in the past slides. Next. Now this is the IPO frenzy. So in the main board, in the top table, we are seeing that the IPOs have got oversubscribed by 130 to 320 times. And within that, the non-institutional investor, that is the HNI investors, have seen very high subscription. The second table is SME. SME the subscription has been between 718 times to 2000 times. So this is where the frenzy is, and SEBI is trying to sort of address this frenzy. Yesterday also they have brought some new regulations to try and stem the flow of money and flow of IPOs. Wari Energies saw 97.33 lakh applications and Bajaj Housing Finance saw 89 lakh applications. So these are very large number of people applying in IPOs. So now what is the view going forward? So retail and HNIs have seen a fast rise in their portfolio values. Most of them, some of them as I discussed are disappointed. They have made money by trading, short-term trading, intraday trading. They have made money in IPOs. Wealth has been created for a lot of them, but the money is being redeployed in the markets. They are very few of them are sort of wise enough to take out money for towards other asset classes. No big correction has been seen since March 23 except the election day volatility. Risk appetite has generally grown across the board, whether it is retail, HNI, because people have not seen any kind of correction. There is a FOMO feeling generally that my neighbor, my relative, my friend has made so much money and I have not made same amount of money. 60% of active clients in the NSE have come post March 21 and 80% have come post March 20. So those people have not seen any sharp dip. Markets have dipped between 23% to 60% in the past from the recent highs. So that kind of fall has not been witnessed by any of these new traders or new clients. So what will happen when such a kind of a fall happens? That is something which we will have to see. Now, the HNIs are now becoming more open to investing in PMSs, AIFs, direct equities, ULIPs, etc. All form of equity participation. So they are not sort of closing their minds to one or two kind of equity exposures. Nifty has seen 9 consecutive positive years so far. And now we are in the 10th year. Even this year is going to end in the positive. So how long this kind of a positive, consecutive positive returns can continue is one question. And whenever a negative year of return comes in, how will the retailers behave? That is something interesting which we'll have to watch out for. Yeah, so I think over to Devarsh.
Thank you, sir. So, as we have written, stocks to accumulate. That means these are the stocks which we like. Yeah, can you just move to the back, one slide back? Just keep on the title, yeah. So, the keyword is to accumulate. That doesn't mean that tomorrow morning investors should go and buy these 10 stocks. It should be invested over the year through systematic investment plan. These are not the only stocks which we are recommending. We have 200 stocks which we have a positive view on. This is just a sample list which we have curated just to highlight the way a portfolio should be constructed, a SIP portfolio should be constructed. So next please. So to tie what we have been telling, what Varun mentioned, that about 60% of the portfolio should be in the large caps. It should be on the established companies. And if you see on the screen, Hindustan Unilever, Reliance Industries, SBI, Bajaj Finance, Sun Pharma and Maruti. These are the 6 large companies which we have put in a portfolio of 10 stocks, 60% in large cap. And then another 4 are mid cap, small cap companies where we have chosen from different sectors. So let me start from the back. Last stocks first. Just to make it a little more interesting, 10% of the portfolio should be on the new age companies. We have chosen one as India Mart, but many large established new age companies are coming into the market, and we feel that the 10% of the portfolio should be there. Recently, our institutional research covered Swiggy and other such new age companies should be part of your portfolio, 10%. Varun mentioned that gas companies are looking positive from the absolute return perspective on oil and gas. So we have chosen one company, Mahanagar Gas. And the idea is that company which has a good business going through some temporary headwinds, and if it is available at an attractive valuation, that is the time when you should pick up companies like this. And that's why we have chosen MGL. Real estate as a sector, we mentioned that we are positive, the cycle is strong, and that's where we have chosen one of the prominent real estate developers from Bangalore, Shobha. Shobha had a couple of challenges of the approvals in the first half. Those approvals have come in, and we think that there are going to be a good number of launches in the second half, which will show these launches will see a lot of revenues coming in, and that makes it a little attractive for us. Consumer, we all know the India consumption story. The middle class is consuming more and more, and here is the company which is Crompton Consumer, 75-year-old brand, which is now one of the leading consumer companies. It is one of the outlier in the consumer space because as we've seen, the urban consumption is slowed down. Here is the company who was able to do a double-digit growth in a tough environment and absolute increase in the profit and sales, while other competitors actually struggled. So that's why we have chosen this. So these are the 4 small cap, mid cap companies we have chosen, and the other 6 are large established companies, market leader in their own industries. So starting with Hindustan Unilever, it is the largest FMCG company. RIL, which is the largest private sector company, largest in terms of revenue, largest in terms of market cap. SBI, the largest private sector bank. Bajaj Finance, the largest NBFC. Sun Pharma, the largest pharma company. And Maruti, the largest automobile. Market leaders, established companies in their segment. These companies relative to the Nifty have not performed, but we feel that if we accumulate these 6 companies over the next 12 months as a SIP, we are likely to beat the index with the construct. So I'll just spend talk about 1 or 2 lines about each of these companies. So HUL, as we know, it's the largest FMCG company. Interestingly, HUL is the only company where they have about 50% of the revenue coming from the rural India. And as Varun mentioned, we are seeing the green shoots coming into the rural India. They have already done some price correction. They have done some premiumization. So on an absolute basis, compared to the index, many of our portfolios have underweight, as Varun mentioned, but we think that if we accumulate HUL over the next 12 months, we can make a good amount of returns out of it. Reliance, largest public sector, public company by market cap and revenues. Interestingly, they are also investing into a lot of new energy businesses like 100 gigawatt of solar energy. They are coming out with the gigafactory in battery side, hydrogen production facilities. So the cash flows which they are generating from their traditional businesses, they are investing into the new age businesses, and hopefully in next couple of years they are likely to do well. They have given a guidance that they would like to increase their operating profits by double in next 5 years. Here is the largest company giving a guidance that they would like to increase their operating profit by increase the profits double in next 5 years. So obviously the stock has corrected about 20%, 25% now from the high, and we like to invest in such companies. So SBI, Bajaj Finance and Sun Pharma, these are the large 5 companies, 5-6 companies which we have recommended for SIP over the year. Thank you.
Thank you. So you heard all my colleagues, our MD spoke about global trends. Then we heard about Indian trends. They were cautious. There's a bad news followed by there was a lot of good news as well. So we may have mix of sentiments, but one thing remain very common about the positive about Indian economy in a medium to long run. So every forum, every place when we look at, we end up hearing that India story remain intact. So what next? When we look at last 5-6 years, we have seen good investors coming in DMAT through mutual funds. ETFs portfolios are growing. Equity participation is growing. So that gives the confidence that how younger investor class are participating in the equitization of savings. That's our favorite term of our MD, that how savings are turning into equitization. So coming to, if I look at trend, so you see that with the projected real GDP growth of 6.5%, India is expected to be the fastest growing economy. And when you grow with this kind of GDP, you create more savings, more investments. And that, if we project that way with a 28% savings ratio, that also becomes way above world average ratios. So from 1 trillion to 3.5 trillion current economy, Indian economy is expected to be third largest economy by CY 27 and expected to be the 10 trillion economy by CY 33. All of us are aware when the middle class income raises that how it contributes to the consumption and the savings. So Indian middle class also expected to grow with 5% CAGR with current with FY21 with 432 million to over 1,000 million in financial year 47 and 31 it's over 715 million. So that shows the kind of earning is growing is passing on to the middle class segment. India per capita income, is expected to grow with a 9% CAGR and expected to grow in next 5 years to over 4,000 USD, 4,281. This and good part is when you look at asset management, the constant participation of equities, funds moving from cash and savings to equities are healthy. And if we extrapolate for the next 5 years, so, when you look at mutual fund, PMS, AIF put together, this is expected to grow with 20% CAGR in next 5 years. When you look at mutual fund to bank deposit ratio, which was 11%, 5 years back, is expected to, is already grown to 27%. Ultra HNIs, middle class I spoke about. Ultra HNI is also expected to grow with over 8% CAGR, and I think all my co-colleagues talk about equity participation, and we have seen that with equity, direct equities and mutual fund put together, it has already crossed 16%, which was single digit, has already crossed to 16% as a holdings in financial assets, which is expected to grow over 20% by next 2033. When we have looked at 18 crore demat accounts, where unique demat accounts are over 10 million, but how many are actively participating? It's 1.44. It's less than 2 crore. So 1.44 crore people, unique customers are participating month on month. Where all of us have heard about derivative frenzy, but if you look at the numbers, it is less than a 50 lakhs number trading month on month, creating that kind of volumes. But if you look at and we compare the similar in China terms and US term, so it against the PAN numbers, so it's a 12% of the population in Indian context, whereby if you just do apple to apple comparison with China, it remains 20%, and with the US, it's a 60% of the population. So we are way below when we look at our relative comparisons with other countries. So this continue to have a lot of scope, even new investor class coming and participating into in the equity space through direct equities, mutual fund, and ETF. Those are the upcoming space which are we have seen constant traction in terms of SIPs, mutual fund flows, and PMS and AIFs. So in nutshell, if I summarize mega trends which is impacting the broking industry, is a strong middle class growth, per capita income, which is growing over 9% CAGR, asset management under AUM growth, which is over 20% CAGR, growing shares of equities and mutual funds, and Indian broking industry is still under-penetrated. Financialization, story, Deepak ji talked about the way, IPO participation is happening. This year remain very strong. In fact, last few years remain very strong in IPO participation. Derivatives, India is way ahead in relative any comparison of the, worldwide, though their recent circulars have come, recent guidelines have come in derivative, but still our equity to derivative ratios are non-comparison. I think cash is a bigger opportunity. So far, I personally feel in the haste of derivative growth, somewhere the cash story lost over. I think the time has come where the cash has to be focused on, and how bring the importance of the cash equities and participation of retail investors, which remain in single digit in terms of cash holdings, how we can take it forward, make them more aware by the way of systematic investing, and by the way of mutual funds, by the way of equity, by the way of ETFs, and they periodically can remain into the cash segment that can give a larger participation. When you look at FPIs and FPIs I spoke about, FPIs though remain very integral part of the Indian's growth story. But whenever FPI used to make exits, Indian market used to tumble. But of lately, the retail investors and DIs have taken over, and the dependency on FIs has already, is a multi-layer low. In fact, is the lowest. As far as FNO is concerned, all of you are aware that we got hit by the multiple circulars which have come into last few months, from increase in taxes to
true to the label, and then consolidation of weekly expiries, increase in lot sizes. Some of them has already taken place. Some of them is expected to take place in few months from here on. And we have seen the turnovers are significantly down over the November in the month of December, like Nifty 40%, BSE 30%. But I think these are initial transition, adaptation of the new behavior, adaptation of the new new behavior at both from the consumer point of view, from from the even the prop or algos point of view, where once this becomes new normal, then it is tend to see that how it's it's turned up. But I feel it's not about markets where the markets have corrected. It is all about how the behavior have corrected, because when the regulator objective was to protect the retail investor class, that results into their increase in participation and into the remain in the markets, because we see the longevity of the retail investors remain very low, but that's largely contributed towards derivative participation, because when you do deal with derivation, you end up moving out of the market. I think I'm very hopeful. In past also, a regulator came with whatever measures that has resulted into the rise in the market and the participation, and the similar way we expect that such regulation will help investors to remain in the market, not only remain in the market but also in the increased participation. Coming to technology remain, the underlying asset. We have seen last 5-6 years the robust growth, that to leverage the customer's data. I think the kind of work was done through Aadhaar and internet, which has helped simplify the KYC, and the KYC, the digitization of KYC helped quick onboarding. That helped so many accounts, demat accounts got opened quickly. Today, average demat account in the industry get open in less than 10 minutes. So that helped investors to get. But it is not only about demat account. Over the past few years, a lot of digital brokers came where the execution became digitized. So from KYC digitization to execution digitization, the industry quickly moved in. But the real challenge is what to execute. If you don't know what to execute, you end up opening account. You end up to end up opening account, to end up executing. There is a one thing called decision making. How to empower that decision making? I think the time has come for the industry, because the unique customers still remain less than 5 crore. So 18 crore demat accounts with less than 5 crore active demat accounts shows the kind of gap is there, which has to be curbed, leveraging technology. How we leverage customers' own persona, own data, help them to provide them those insights which can help them to take decisions making, leveraging research, robo advisory. I think generative AI is picking up way fast. This can help be more personalized. 50% of our Indian population are Gen Zs, which is more digital as a behavior, not as a nature even. If we need to solve their problem, we need to leverage such technology tools to be more personalized or more nearer to customer, which help them to end up making decisions. So I think as an organization, we are investing a lot in our technology. Last 2 years, we were actively building up our own in-house stake in terms of product, product side, tech side, marketing side, everywhere we are invested, and which is and both our applications are in-house, and we continue to remain committed to invest in technology and provide best of the solution class to our investors. Thank you very much.
Thank you so much for your insightful look into the 2025. I will now open the floor to any queries that you might have, and accordingly, the panel will answer your questions. Yeah.
I'll directly come to the MD, sir. First of all, it was a great insightful, and according to this presentation and the research which we have seen by HDFC, we can definitely say that the cautious year is ahead of us. Directly, how much return you are anticipating from calendar year 2025? Like in this year, we have seen Nifty giving 10 to 11% of returns. How much return we can anticipate from CY25?
I think we believe that the markets will continue to do well, though it will be volatile. So our target is close to about 26,422. This is based on our earning estimate of about 21.5 forward earning. This will hit sometime in the next year, may not be at the fag end of the year.
Thank you.
Yeah, CY25 target. 26,422. That's the number, Devash? Yes, sir. Exact number. Yeah, 26,482.
That's for the Nifty.
That's for the Nifty, yeah. Not for the Sensex. I think you can extrapolate. Can't hear you, sir.
Now, yesterday there was a SEBI board meeting wherein there were some directions about the merchant bankers. How do you look at the impact on your business and for the industry?
Impact on our business will be very limited. I think it will have an impact on some of the broking firms that are carrying merchant banking activities. So to that extent, impact on HDFC Securities will be very limited. But yes, I haven't gone through the details. I don't know whether you have any view on the same. Yeah.
Okay.
My question is to you, as you mentioned that IT sector, you're neutral about it. Depending on the Trump government in US, we are expecting, a higher expenditure in IT. And based on that, also those IT sector, as you said, they're they're available on very high valuation, but the P ratios, if we see, they're quite lucrative as of now. So why not putting overweight on IT sector, and why neutral on IT sector? I would love to understand that.
Yeah. So, see, I think you're right. The growth rate is expected to increase next year. I think, with or without Trump, in both the scenarios, we were building in an uptick. But the uptick is only from 2 to 3% dollar growth, which we saw last year, to going to only 6 to 7%. See, it's a very large industry, and the growth rates are quite linear out there. Indian IT services I'm talking about. So on that large base, it's very difficult that they would outperform the expectations. Instead of 6-7%, the probability of that number being 15%, I would say, is extremely low. So with a 6 to 7% dollar revenue growth, the earning growth for the sector next year should be closer to 10% in our view. So the rally in this entire year which has happened in IT sector is already building in that recovery from 2 to 3% growth, which they have been at till now. So market has already discounted the expectation of higher growth in the next year, with the valuations moving up. Coming to the second point, that valuations are lucrative. At an aggregate level, we don't think so. Large cap IT is still okay. They are closer to 30 times, 28, 30 times. It's also on the higher side, given again the fact that it's a large sector, global sector, and therefore the long-term growth rate for this sector cannot be more than 3 to 5% from these levels. Therefore, this is not a sector which, like consumer, can trade at 50, 60 times, because for consumer sector, if the long-term growth rate is 10 to 12%, for IT sector it would be 5 to 6%. So half of that. So therefore, the valuations for IT companies should ideally also not be more than 25, 30 times. And a lot of the mid-cap IT companies are now trading at 50, 60, 70 times. Some of them are obviously growing at 15, 20%, and therefore they are commanding those valuations. But how long that 20% growth for those smaller companies can continue, that we have to see. So it's very bottom-up, company by company. So at an aggregate level, we see limited upside risk to either earnings or valuation in the IT sector, and therefore we are neutral.
I have a question. This is Abhinav from Mint. So when we saw that in the accumulation slide, there was a case made for NGL. Right. So, is it based on the expectation that natural gas would be bought under under the ambit of GST anytime soon? Like, how are you seeing the the margin problem being solved? Because deallocation is expected to continue. Cheaper gas, LNG prices are not coming down anytime soon, and also CNG prices can't be increased if that will reduce the discount of TOC. So, what is the thought process?
So I'll quickly give my view, and then maybe Devarsh can add, because that slide was put by Devarsh. So see, on MGL, our thesis is, the APM allocation led hit which has come on margins is going to stay for some time. So there is no doubt about that. But at the same time, if you look at the volume growth story, is still reasonably good. The volumes have been growing in high single digit. If you look at CNG vehicle sales, everything is still, I would not say, growing at very high levels, but it's a very respectable growth of 8 to 9%. And the margin hit, while it will stay for next, 6 to 9 months, from there on, it is going to again improve. Margins are going to improve, maybe not go back to the earlier levels, but margins have more or less will bottom out in the next 1 to 2 quarters. Q2 was obviously bad, Q3 will probably remain like that, and then gradually they will start to improve. And valuations now after the correction at around 11 to 12 times, which is there for both MGL and even IGL has derated to close to 13, 14 times, are fairly attractive if you were to believe that they can grow in mid to high single digit over the long period of time. So the implied growth at current multiple, given these are still reasonably good ROE businesses, is around 3 to 4%. And we believe they can do better than that in the longer term. So it's not a short term call that, we don't see anything changing in a hurry for the sector in the next 6 months. And therefore, probably accumulate is the right word, that you kind of accumulated these in these stocks through 2025, and then hopefully in the next 5 years you should continue to make some decent compounding from those levels.
So you see some expansion in the distribution network, because most of the bidding was done by the unlisted players, or
yeah, but if you see, there are some expansion. Again, it varies from company to company, but there is a generally growth in, so there new GAs are being added. The geographical expansion is there within the same geography. Also, you are still seeing growth. So this high single digit growth that I am talking about for CNG vehicles and all is more on a like to like basis in the same geography. And if you add more geographies, then your growth rates tend to be higher.
Do you see further traction in CNG vehicles in 2025?
I think continued traction, not that, given the fact that, the oil prices are not going up in our view anytime soon. They're not going up significantly. The relative attractiveness of CNG should not improve much, but at the same time, given the CNG pricing, it still, makes sense to switch, and therefore the pace of adoption of CNG, which we have seen in the last few years, that will continue at the similar pace in our view.
What about the GST on natural gas? What is the expectation? The market ran up last month already.
Yeah, no strong view out there. It's possible, but we don't tend to play, or base, our thesis is not based on those events. Very unlikely to say what they would do.
Thank you.
Yeah, just to add, so he has already covered that the CNG vehicle numbers are strong. The price gap between the CNG and the petrol diesel is still there. They are adding geographical areas, they are adding industrial customers, and the valuation point, still it is trading at 30% discount to its 5-year average valuation. So when good companies where regulated returns are there, where returns are assured, when they are available at an attractive valuation, you should, if you accumulate them, these policy headwinds will go ahead, remove in next couple of months, and then the stock is likely to perform. So that's why we have added them.
Next couple of months.
Yeah, so next 3 to 6 months, as Varun mentioned, once the, as you mentioned,
so policy headwind will not go away, but it will get discounted. It has already got discounted in the price, and margin expectations have already come. So there will not be any further margin deterioration, and gradually margins will improve.
Yeah.
What is the housing of the rupee? It is down 85. The rupee outlook.
Yeah. So at this point in time, I think the view is the HDFC Bank economists. We use the HDFC Bank economist team, which is sitting in Delhi. Their forecast, they are expecting the rupee to depreciate by around 50 paise by the end of the fiscal year. to a large extent driven by, one is the outflows which are happening. You would also have seen last week, actually this week, the trade data which has come through. While that was a little bit of one-off because of gold prices as well, but at the same point in time, the pressure which is there on the export sector is something that we will keep an eye on. At this moment in time, while the data is a bit dire, you also expect that some of this will normalize now that the gold pressure should go away. And on top of that is the fact that it doesn't look like any trade issues from the US will be anti-India in a hurry. So from that perspective, there is a negative bias to that. We expect the RBI to continue to smoothen the fall in that, so you can't expect very volatile, but there will be a depreciation bias in the rupee. Expect, 50 paisa or so depreciation by the end of the fiscal. Yeah, that's about from today. Yeah.
So you said the war against inflation is almost over, but how much will that get upended, say with Trump assuming office and with his disruptive policies, and that's one, and how will that impact markets, next year, and that's one. And secondly, you also said you expressed your concerns about young investors, how they'll react in a year of muted returns, but we also have a scenario where people are convinced that equity is the best place to beat inflation, and we definitely have a regime which is incapable of taming inflation or giving real returns in other places. So since that message has been entrenched, how will that play out? And any view on telecom sector? Anyway, there's one sector where they have passed on the price hikes successfully, it seems. And are there any other sectors or segments where which will continue to do well regardless of what the broader economic slowdown and stuff, apart from whatever you have said about discretionary spending?
So three questions. I'll leave telecom sector to Varun to talk about it. We have given you sector-wise view already for almost all the sectors, but telecom, he will talk about it. I think 2025 will be a difficult year, but there'll be bottom-up stock picking opportunities. That's something we'll have to focus on. That's something we've been saying very clearly, because we are approaching the year with the almost fully valuations. So that's where we are. We believe that last 9 years, like Deepak mentioned, the Nifty has given positive returns only. The young investors who have been in the market for a few years haven't seen significant corrections in the market. So we don't know the response of the retail investors who have been seeing only positive return to the negative returns. So that's where we are concerned. We believe there'll be some kind of a jolt and some negative reactions from them also, which could lead to probably stopping some of the SIPs or moving away from the market and less traction in the market and so on. They may take over after some time passive route. So that's our expectation. That's our learning from the retail investors' behavior. But having said that, one thing I can tell you that in HNIs, semi-HNIs or mass affluent customers, we have seen a lot of resilience and understanding about the volatility, how to navigate the volatility in the markets. So that's answer for the retail piece. Your first question on the inflation, I made the statement the war against inflation is over in the context of that in 2022 inflation peaked at 10% plus world inflation, and from 10% it has eased out significantly. That's where I said the war is over. However, at the same time, I have also said that the inflation have been stubborn and it's not going to go away at the speed or at the pace we were expecting. So maybe we will see some kind of a tweaking in the monetary policy action. So which is what we've seen in the yesterday's announcement also. Instead of 4 rate cuts, 2 rate cuts, India may take its own sweet time also. And then I spoke about the uncertainties arising out of the change in the policies with the change in the regime at US. Yeah. So Varun, you can tell them about.
on the telecom sector, you're right that it's one sector which has exhibited good pricing power. They have been able to take price hikes. If you look at rest of the economy, actually pricing power has been fairly muted, be it cement, be it consumption. And even in case of telecom, we believe, the price hikes started a few years back from very depressed levels. And so far they have got absorbed. But we are starting to see greater resistance to kind of price hikes. The loss in subscribers is there for the incumbents, which is a bit more than what was expected. So we believe the pace of future sort of price increases will be a bit moderate in case of telecom sector. And in the context of the fact that penetration is already near 100%, right? Everybody has the mobile phone, so it was never a volume growth story. It was always a pricing story. And coupled with the fact that valuations have moved up quite significantly for most of these companies, Bharti and Jio, and for a utility companies, they are now looking slightly, I would say, on the expensive side, and therefore we have been cutting our weight on telecom sector. So that's the view. Right now we are underweight on telecom. We are underweight both Reliance and Bharti.
Ashok from the Hindu. My question is regarding FPIs. What will the fund allocation within emerging markets be like? Would the month on month or in the rest of the year kind of reduce for India? That's my question.
So, if you look at the historical trend, about 2018 or 19 is when the ownership of India Inc. peaked for the FPIs, and then it's been steadily falling, all being absorbed by the domestic. What's happening is that actually in this year, at the start of the year, so now coming to more recent history, the big trend which was going on was the fact that China was looking relatively very cheap as compared to India. With a significant gap, actually. There were a lot of companies which are trading at 35, 40 times in India, and the relevant competitors are single-digit PE in some case, and at the start of that, yeah. So there was a bit of switch. But recently, I was on a trip to the US, and even Varun's done a marketing trip to the US. What we found is that the selling in India now has become independent of moving into China. So that switch trade is over. While China still remains at a significant discount, what's actually happening now is that people are looking, the FPIs are looking at these as independent trades, with China having its own drivers, and to a large extent also because Mr. Trump's got elected, they want to see actually what happens on the geopolitics there. India, anecdotally, we can say is that generally people with all of this selling are slightly underweight. Now, usually that tends to be a good sign because it tends to show that as and when interest comes back, it will be an easy one to come back in. That reverse, even though we had thought would happen somewhere around the end of the year, has not happened. In fact, actually, the selling numbers for December are actually a lot starker than you think. I've worked at JP Morgan and Merrill Lynch before and Macquarie, and we used to find that December used to be quite quiet, but that's not happened this time, right? I think what's happening is that it's not, so the way it feels like the top-down story is being driven is that one, there is a risk-off which is making money move, and there was a chart covered by MD in the initial part, which was that significant amount of money is moving to US equities. In fact, for the last 5 years cumulative, it is a factor of 4 maybe, where 4x the amount has been invested in US equities versus rest of the world combined. So, whenever the US is sucking equity money out, it tends to impact everyone. Within that is the emerging market basket. Within that, India would be a little bit of an underweight. We believe that on that, there may not be that much room to fall further. So in that sense, but at the same point in time, the earnings are expensive. So what we want to see, what we expect to see is that allocation-wise, India may not become increasingly more underweight. That might actually start to come back with earnings, but it's more likely to come back on where earnings delivery is. So if you look at Varun's model portfolio, you expect some buying to come in on some of the consumer and some of the financials names this year. That is what you can expect.
Yeah, so apart from the equity piece, 2024 was a significant year where Indian government treasury was added to the global emerging market bonds indices. It started with the JP Morgan in June. Bloomberg is going to add India into January 25. So on the debt side, we are getting a lot of inflows. On the fully accessible route side, we are getting a lot of inflows, and that's why the rupee hasn't depreciated that much, and or is not likely to depreciate that much given the circumstances, because we are getting a lot of inflows from the debt side. And as on the equity side, I said, we are underweight, and a lot of investors may put in new money into India in 25.
As for corporate earnings, when exactly do you expect a return?
So Varun will add to what I am going to say, but the last quarter was soft. We are already seeing the green shoots on the high frequency data. One of the reports which we come out with, the Indian Barometer report, where we have already seen the signs where high frequency data is improving. So this quarter is likely to be better. But
So
Varun.
So as I said earlier, first half, the 230 stocks that we cover, YOY earning growth was flat. On a second half, we expect it to be around 8 to 9%. And it's not that suddenly we are seeing that much of a growth pickup in the, in the economy. Even with economy remaining the way it is in the last few months, we'll see that naturally because of the base effect. Because as I said, certain companies, OMCs and all were pulling down the overall YOY earning growth, which was making a lot of headlines that, the earning growth has become zero for India. We believe second half itself, starting from Q3 itself, you will see a 8 to 10% YOY earning growth. And it should remain in that band or marginally inch up to low teens in FY26. That is our bottom-up sort of number basis the 230 stocks that we cover. So, so it's still a slowdown from that 17% earning CAGR we had for 5 years from 2019 to 24. And that is unlikely to get repeated because at that time, the earnings were really depressed across multiple sectors, which is no longer the case. Now most sectors are sitting at long-term trend average or above trend average kind of profitability. So therefore, one has to get used to a lower earning growth number, but it's still going to be in the range of 10 to 12% on a yearly basis. And therefore, we believe the expectations on the returns also has to commensurately come down because the room for PE expansion is also not there.
So how much of a bearing would the rate cuts or the absence of them, of domestic RBI rate cuts, have on equity investors in general? Suppose the policy rate cuts come at 25-50 basis points. So would that be taken as a very shallow sort of a move, or would equity investors be swayed by the optics of a rate cut really?
See, so in case of India anyway, there was never an expectation of a very sharp rate cut cycle, because India did not see a very sharp rate up cycle also like the US, where interest rates went from 1% to 5% within a matter of a year. In case of India, our economist view is in total of around 50 to 75 bips rate cut at best for the. So it's going to be a shallow rate cut cycle anyways. Without even considering yesterday's event, where if US has a lower rate cuts, then India will have even lower than probably US in case of, given the currency pressures which are also there. So I don't think that investor should be investing into markets with the rate cut theory, because actually that rate cut typically leads to PE expansion, which has already happened. So markets were anticipating this sort of a rate cut cycle both in US and India, and therefore 2024 has seen a positive, fairly good sort of a returns. If rate cut cycle is shallower, that is another reason why there could be a chance of a PE derating, because while rate cuts will happen, but the expectation of rate cuts was more, and if they don't happen to the extent which was expected earlier, there is a possibility of a PE contraction, which will lower the sort of returns compared to the earning growth which we will see.
To add just one point, a lot of corporate deleveraging has already happened in that sense. So the savings of lower interest rates may not be a very big sum. Number two is that in the past when rates were going up, we did not see markets moving down. So in that sense, the relation, there's no positive correlation. And I think what is important is the GDP growth and the spending. So if these are in place, then rates don't matter to an extent. So if GDP growth picks up and if capital spending and personal spending or incomes grow at a decent pace, then 50 basis point, 100 basis point here or there may not matter much.
Because, as Devash also said in the beginning, earnings are a more predominant part of the returns that you get and not so much the PE expansion or this thing. So, and especially given the PE that we are sitting at, we don't see a big swing either way on the PE. The macros are still good enough to not cause a very sharp PE derating. At the same time, the earning growth or the rate cycle is not very favorable for a very big upswing in PE. So effectively, your returns are going to be in the vicinity of the earning growth which we will deliver.
Thank you so much. Now, any queries that you might have, you can take it offline. We have served the lunch, so you can join us there as well. Thank you panel. Thank you, journalists. Thank you.